Hi, I'm Adam Hughes.
I'm Craig Jennings.
We're the fiscal policy team at OMB Watch. We're here at Timberlake's right down the road doing a 2008 year in review watcher. So why don't we start talking about the economy and the stimulus that's happened throughout the year that Congress has enacted. Can you talk a little bit about that, Craig?
I really prefer not to talk about the economy. It's been awful.
No one really wants to talk about it.
I mean, they say it's not a problem. It's not a recession until you lose your job. So,
right.
I mean, I'm fine as of December 11th, and we'll see how that goes in 2009.
Exactly.
But 6.7% unemployment rate right now. 533,000 jobs were lost last month.
That was the most since 74.
Yeah, 74. And it's been a while since we've seen things this bad. And a recession was just officially called. Just recently. It started in December of last year.
Well, long before people thought it ever did.
Yeah, I mean, and certainly to a lot of people, it felt like a recession.
So what happened? What did people do about it? I mean, what has happened to try to alleviate some of the problems with the downturn in the economy?
Well, so we go back a year, and the unemployment rate in December was 4.7%. And then in January it jumps to 5%, and we hear this word stimulus. We also hear three other words: timely, temporary, and targeted. So January 4th, we're, when the unemployment numbers come out, we're right out the gate. It's going to be a bad year. Congress anticipates this. We have to do something. Quick, man, to the spending machine.
But President Bush said he didn't think it was really that big a deal.
Yeah, I mean, he's really skeptical. He's like, 5%, that's nothing.
See, and the funny thing is that he was actually right.
Yeah, it's true. I mean, historically 5% is not bad. He just didn't look at the months before it. 4%, 4.5, 4.7. The numbers going up. And he eventually capitulates and signs a bill that Congress passes, a stimulus package, which turns out to be there's some other stuff around the edges, tax incentives and whatnot, but ultimately it's a $168 billion tax cut. I mean, you remember it if you got a check in the mail, the government is like, well, we need to give these people money to go buy TVs to prop up the economy.
Right.
Which is great, except they bought the TVs last year and used the money to pay off their credit card from the stimulus bill.
So it didn't really have the effect that Congress wanted it.
Yeah, it was a little bit less than they anticipated. But but we did see the effects in the GDP numbers. I mean, it wasn't awful. They could have been worse.
Right.
We didn't see real contraction until I think third quarter when the numbers came out. So Congress puts $168 billion on the table in a stimulus package. But really, this drawback in the economy is it's a symptom of this underlying thing going on here, which is the housing market.
Right, and when Congress tried to address some of that too early in the year.
Yeah, I mean, they looked at it and they said, what the real problem here is? All these people are getting foreclosed on, they're being kicked out of their houses, it's all this wealth has evaporated in the economy. We really need to do something about this, and they did. I mean, they passed something. Well,
Senator Dodd and Barney Frank.
Right, Barney Frank in the House and Chris Dodd in the Senate. The dynamic housing duo got together and decided let's guarantee about $300 billion in mortgages.
Right.
And it's a voluntary program for the mortgage holders. That the mortgage holders would have to come to some agreement and agree to take back some of the loan, reduce the principal, and then it would be guaranteed. It's not entirely clear though that that's actually worked out like it's been planned.
Well, CBO estimated that it was going to save about 500,000 foreclosures, but I think you're right in that people think we've read a bunch of things and reported on a bunch of things that it wasn't really big enough to have the impact that the people who crafted it wanted to have.
Yeah.
And I think it kind of started the tier 2. Which is the financial bailout mania that we've had all year. Because these bad mortgages, the people that are being foreclosed on, were packaged up into investments that investment banks and other financial houses bought and sold with each other.
Yeah, I mean, so you have this housing thing going on, but in a funny thing happened in March of this year, and that would be this giant this investment bank, Bear Stearns. It's on the verge of collapse.
Right.
And the Fed decides, and we're going to hear this phrase later on in the year, too big to fail.
Sure.
It steps in and it basically brings J.P. Morgan to the table and says, hey, you need to buy this company, and I tell you what, we'll guarantee about $29 billion in bad assets. And keep in mind that these bad assets, which become known as toxic assets, troubled assets in a bill name eventually, are seem to be the problem here. That's what everyone's looking at. Well, if we take these assets off the book, if we guarantee them, things should start flowing again.
Well, the problem is it was freezing credit markets, right?
Yeah, I mean, it was clogging up the system.
Banks didn't want to trust each other anymore to lend money because they thought everything that everyone owned was
I mean,
crap.
if you've got bad stuff on your books, I don't want to lend you any money because you could go belly up tomorrow. And the Fed's thinking the same thing. But they let Lehman Brothers, another investment bank, they go belly up and
they didn't bail out Lehman Brothers, but they did Bear Stearns.
Yeah, and so it's kind of like, well, what are we doing here? I mean, and again, there's all sorts of questions. Is this appropriate? Should the federal government be stepping into this and backing up, these assets in the free market, supposedly?
Sure. Well, and I think a lot of people said that it probably wasn't appropriate, and then maybe we needed to go through a little economic pain.
Yeah, nobody was sold on this.
Sure.
And the Fed was, they explained it, and so well, we have to do this, or this will happen. It'll be really bad. Which might very well be true.
Well, I think everyone agreed that something had to be done.
Right.
But it's just unclear whether what happened was what should have happened.
Yeah, I mean, and then after Lehman Brothers goes bankrupt, AIG, American Insurance Group, they're on their ropes.
Well, then it moves beyond purely banks and investment banks.
Yeah,
we're talking about insurance companies.
Yeah, I mean, so the Fed decides, well, it's not just banks that we got to back up. Let's back up this insurance company, and they loan AIG $85 billion. Now, so I mean, today when we hear the word trillion, nobody really bats an eyelash anymore. Sure, it's kind of troubling, but back then, a short 6 months ago, $85 billion was a lot of money.
Seemed like a lot of money.
They did. Yeah, so they backed them up. But like what you're saying, I mean, there's these one-off things. We save this, we don't save this,
right.
We save this.
It didn't seem like there was a comprehensive plan.
Yeah, I mean,
so no one came in and said, I know what the problem is, I'm going to fix it, everyone chill.
Yeah, and nobody knew what was coming next.
Sure.